Hi there, welcome to Market Call. I'm Lindsay Biscaya. Ernest Wong is on the show today. He's head of research at Baskin Wealth Management, and he will be taking your questions on North American large caps. Here's how you can reach us. You can call us toll free, 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. And Ernest joins us in studio. It's good to have you.
Thanks for having me.
It's been an interesting year so far. I feel like I start every day saying that, but every day there seems to be some new development. Let's start with the TSX. It had a bit of a run last week, down yesterday, seems to be rebounding today. What do you make of what we're seeing with Canadian markets this year?
So the way we look at the TSX is it's almost like we're back to the early 2000s when you had commodity prices soaring, gold and oil stocks are kind of trading at near all-time highs. And on the flip side, you have the technology sector, so companies like Shopify, not Reuters today, but Reuters in general, Constellation Software. That is kind of, these stocks are being impacted by worries about AI and how that plays out for them. So if we look at the TSX today, kind of over a third of the index is made up of commodity-related names, which is kind of what it was in the post-tech bubble period as well.
Interesting. Is that where you think investors should be looking as kind of like a safer place to go, is companies that are, in the commodity section?
No, so I think that what the implication of that is that the TSX is kind of increasingly detached from the underlying economic fundamentals, from the consumer-driven portions of the market, where so much of the index performance is now going to be driven by the commodity prices versus things like imports, exports, things like loan performance from the banks, and what kind of ordinary Canadians are feeling on a daily basis.
Is that a good thing or a bad thing?
Well, that's just the reality of the markets.
Okay. Speaking a little bit more about the economies in general, there's a lot to look forward to this year, a lot to look at, including the renegotiation of CUSMA. I know there's a lot of eyes across North America on those renegotiations happening in the summertime. How do you think those will go?
So I think that it is obviously the key catalyst for the Canadian markets going forward. I do think that it will result in a successful renegotiation of a trade agreement between Canada and the U.S., because if you look at there's no doubt that Canada needs the U.S. as a trading partner, but if you look at the key exports that Canada makes to the U.S., things like crude oil, things like steel, even things like forest products or fertilizer, these are not things that the U.S. is easily able to replicate from other sources. And if you kind of look at the key things that Donald Trump is focused on, what he is really after is jobs, for kind of bringing jobs back to the United States. And the focus really is going to be on the auto sector and the shift of the jobs down to Mexico rather than Canada as a target.
Okay, a lot to watch for. We're going to take a quick break right now, but we'll be back with Ernest Wong of Baskin Wealth Management, taking your questions on North American large caps right after this. Stay with us. Welcome back to Market Call. Ernest Wong is joining us on the show today. We're going to go straight to the inbox for a question from Sam. And this question reads, I would like to know your view on Magna International. Okay, what do you think about Magna International?
Yep, so the story for Magna is that they heavily invested to support EV production in 2021, but they spent a lot on customers that ended up not materializing, and they were kind of facing the overhang of that over the next couple of years. And you add to the fact that tariffs were a major impact to Magna, and it took them a while to get the cost recoveries back from the customers to cover the cost that they were paying for the tariffs. But I think that looking ahead, these are past issues. Magna has fixed, they've gotten the recoveries from the customers, and they've been able to fill the gap with Chinese OEMs in many parts, and really focus on gaining market share in kind of the growing areas of the auto market. So things like kind of smart door handles, things like driverless car autonomous systems, and they expect now to outgrow the auto market. They're gaining market share, and I think that they're doing a great job.
So you think maybe it's a buy? or hold if you have it already?
Exactly.
Yeah, okay. All right, we're going to go to the phone lines now. We've got a caller calling in from Calgary with a question. Hi there, what's your question?
Hi, thanks for taking my call. I'd like to hear Ernst's opinion on Algonquin Power. Would he buy, sell, or hold the stock, or does he prefer another player in this space? Thanks again for the advice, and have a good afternoon.
Okay, thank you. You too. Thanks for the question. Okay, so Algonquin Power, is this one you like?
The story for Algonquin Power was that they spent a lot of money trying to enter the renewable space. But they over-levered the balance sheet, and it was a disaster. And they've spent many years trying to clean up that mess, to focus more on being a pure play utility, to clean up the balance sheet, and they have a completely new leadership team. And so I think that the business has now been reset to focus, to have a cleaner story, to be more of a pure play utility provider, which I think is investors like, because it's a little more predictable. You kind of know what the business is. And so we don't own it, but I think that for investors that are looking for dividend-focused stocks and kind of safe, predictable income, I think Algonquin Power could certainly be a decent bet going forward.
All right. We've got Peter calling in now from Niagara Falls with a question. Hi, Peter. What's your question?
Hi, good afternoon. Thank you for taking my call. My question is on Sun Life Financial. I would just like to know why it trades at such a discount to the Canadian banks. It's trading around 13 PE, and the Canadian banks around 18 PE. I'll hang up and listen to your answer. Thank you.
Okay, great question. Thanks for that.
Yeah, so I think for Sun Life Financial, I think the area that that distinguishes them from the Canadian banks is that Sun Life is much more heavily in mutual funds, which are kind of viewed as a mature business, versus the private wealth businesses that most of the big Canadian banks have, which are certainly a crown jewel aspect of those businesses. And I think that is partly something that contributes to the discount between Sun Life and the Canadian banks. I think the other aspect is that insurance overall, in most aspects, there's a kind of a view that insurance has been the best of times for insurers, and that rates are probably going to be coming down in the future. And that has contributed to headwinds for not just Sun Life, but a broad range of the insurers as well. So, yeah.
So if you're looking to kind of invest in something like Sun Life, it's hard to compare it to some of the other banks,
exactly.
Right?
It's not really
different.
comparable to the Canadian banks. One name that we do like in the insurance space that we've been buying is Fairfax. They are a little bit different in that they focus more on the commercial space, and also similarly trading at an attractive valuation.
Okay, back to the phone lines now. Alfred is calling in from Mountain View, California with a question for us. Hi there, what's your question?
Yeah, hi, thank you. Great. My question is about Berkshire Hathaway, medium and long-term the target. I bought it about a year ago. Your thoughts on it? Thanks.
Okay, thanks very much for that. Thoughts on Berkshire Hathaway?
Yeah, so the big story for Berkshire is obviously how the business is going to transition on from Warren Buffett to his successor, Greg Abel. I think that there were initially worries that the shoes were just too big to fill, and it's natural given who Warren Buffett was. But I think we've started to see Greg kind of put his own stamp on the business. He's certainly been making changes to the portfolio. He's been kind of vocal about taking almost activist positions in some of the names, such as Kraft Heinz, kind of telling them he didn't approve of the split. He's made management changes, and so I think he's a very capable executive, and Berkshire Hathaway is attractively valued at where it is today.
So still in a good place, even with that change.
For sure.
Okay. We are going to take a quick break right now. We'll be back with Ernest Wong of Baskin Wealth Management, taking your questions on North American large caps right after this. Stay with us. Welcome back to Market Call. We've got Ernest Wong on the show today taking your questions. We're going to go straight to the phone lines. Raj in Markham, Ontario is calling in with a question. Hi there. What's your question?
Thank you very much for taking my call. My question is about Granite REIT. Is buy, sell, or hold? The earning is tomorrow. Can you please analyze it. Thank you very much.
Okay, thank you for that. Granite Real Estate. If earnings are tomorrow, do you make a decision a day before an earnings report, or what do you think?
Well, I think that for REITs in general, they have been performing well, partly because interest rates have been falling, but also because many of them were trading at kind of deep discounts to their net asset values. And that was certainly true for Granite REIT as well, where there was a bit of a worry for Granite that industrial warehouses were overbuilt during the pandemic, and now they would be facing an overhang of oversupply for many of the markets that they were building in. What ended up happening for Granite was that they're very careful about what markets they choose to operate in, and they have a very clean balance sheet, which allows them to kind of avoid some of the balance sheet issues that are facing some of the other REITs.
Right.
And as a result, the stock continues to perform well. We own it as a dividend name, and we continue to be buyers.
Okay. We're going to go to an email now from Jack, and it reads, how does Ernest view First Service Corporation buy, sell, or hold? Thanks. First Service Corporation, what do you think?
Yeah, we still own the stock. We think that it's a terrific run business that has done a great job of branching into different verticals over the years. The issue for First Service is that there just hasn't been any storms. They're one of the largest providers of property restoration services after large events like hurricanes, and there just hasn't been any storms for them to fix things up, and which is a great thing for society, terrible thing for First Service. Regardless of that, they continue to make acquisitions in things like roofing. They continue to fill out the footprint for residential. And we think this is a good opportunity to buy a compounder at an attractive price.
Okay. We've got another caller. This is Murray calling in from Calgary with a question for Ernest. Hi, Murray. What's your question?
Hi. Thank you for taking my call. My question for Ernest is Lumine Technology, the division subsidiary of Constellation Software, has this also been impacted by the AI ghost out there, or is this a company that can stand its own? I'll hang up and take your opinion, listen to your response. Thank you.
Okay. Thanks, Murray. What do you think?
So I think we're going to talk more about Constellation later as well.
We are, yes.
But for Lumen in particular, they focus more on the telecommunications vertical. It is one example of Constellation finding creative ways to make acquisitions, where they used the stock in essence of Lumine as a spin-off to make an acquisition of a company called Wide Orbit. They're still making acquisitions out there. These are often software that is very difficult for the customer to replace. And I think that shareholders of Lumen, Topicus, and Constellation are going to do very well going forward.
You think so? Because that's quite the drop we're seeing on those charts there over the last couple of months in particular. We haven't had that conversation yet, you and I, at least, about the software sector and that sell-off we saw. You think some companies within that sector are going to be okay, obviously?
No, so I think that there was a headline today from Thomson Reuters where they announced that because they have mission-critical data that cannot be replicated from anywhere else, that customers, such as legal professionals, they are choosing to use Reuters software instead of a general-purpose AI bot like Anthropic or ChatGPT. And I think that is what's going to play out for Constellation, where they are providing kind of mission-critical software solutions for their customers, where to the extent that AI is being implemented, it will be implemented by Constellation on behalf of their customers rather than a disruption potential.
Okay, got it. Yeah, and Thomson Reuters, top of the TSX today, last I checked. Okay, we're going to go back to the phone lines. Don in Woodstock, Ontario is calling in with a question. Hi, Don.
Hi, thanks for taking my call. My question is regards to Brookfield. Back in May of 2023, Brookfield, Westinghouse, and Chemical entered into a strategic partnership with the U.S. government. My question is, which one of the Brookfields would benefit the most from that? They're a conglomerate, right? There's Brookfield Corp, BAM, infrastructure, and the renewable. Which one would be the best? And I'll wait for your answer. I'll hang up now.
Okay, thanks for your question. What do you think?
We've always liked Brookfield Corporation, which is kind of the main mothership of the entire Brookfield empire the most, because that is the one that is controlling the capital allocation decisions at all of these various subsidiaries. it is the one that ultimately controls the decision making at all of these other subsidiaries, and that's the one that the managers have the most ownership of stock in.
Right.
So I think with regards to specifically which subsidiary you would want to play the infrastructure play on, I think that would be Brookfield Infrastructure. But again, reminding that the fees end up flowing back to Brookfield Asset Management, which go to Brookfield Corporation.
Okay, we've got an email now from Mary in Nanaimo, BC. And it reads, can you please tell me what is going on with Wells Fargo? It has dropped a lot since Friday. Wells Fargo, I'll have to check and see what it looks like and how far it's dropped. But do you know what's going on there?
Yeah, so I think with the banks, U.S. banks in general, there's been some worries about, again, from disruption potential from AI, whether it can displace kind of the consumer relationships that they have, as well as Jamie Dimon of JP Morgan, he came out with kind of a very scary warning about the exposure of the U.S. banking system in the last couple of days. I think what we're looking for when we look at U.S. banks in general is companies that do a good job of having a low-cost deposit base, companies that do a good job of kind of cross-selling into other banking services like wealth management. And I think that Wells Fargo has had its issues kind of earlier in the 2010s, but it seems like they've resolved that, and performance is good.
Okay, we'll take a quick break right now. When we return, though, we'll take a look at some of Ernest's past picks. That's coming up. Stay with us. Welcome back. We are going to go through some of Ernest Wong's past picks now. These picks are from November 4th, 2025. So we'll start with the first one, restaurant brands. When you recommended it, it was at just over $93. Now it's at $92. Total return of 0.28% so far. You still like this one?
Yep. Not a lot has changed since November for restaurant brands. The two biggest profit drivers for the business are Tim Hortons and their international business, both of which are still performing very well. The Burger King US business has been underperforming versus where they were hoping it would be because of high beef prices. The turnaround is going a little bit slower than they had hoped, but it's not as material as a percentage of earnings going forward. It trades at a pretty big discount to other fast food peers, and we are still buyers.
Okay, next pick is CCL Industries. So when you recommended this, it was at $77.62, now at $90.59, return and total return of 17%. This has done pretty good so far.
Yeah, so CCL is the label maker. They have done a good job of running the business overall. And they had a good Q3 results. And they continue to make acquisitions and buy back stock. And we think that there's no reason to think that won't continue.
Next up, we were going to talk about this. We teased this one earlier. Yeah. Constellation Software is your last past pick. Recommended this is a pricey one, $3,507, now at $2,414. So it's down. But obviously, the software sector has been through a bit of a run over the last couple of weeks. Yeah. What are your thoughts on Constellation Software now?
So the market is in full-blown panic about Constellation Software, whether it is getting disrupted by AI and whether they will continue to make acquisitions at the same pace they used to without Mark Leonard as the CEO. I think the good news is that the stock no longer appears to be falling every day on new product releases by AI model providers. It seems like the management is continuing to make acquisitions. And in a change from the past, they have said that they're going to have a conference call for their Q4 results. So providing a little bit more clarity around how the management is thinking about the business and how they're implementing AI and view it going forward.
And so when it comes to, you talked about those concerns that investors have with Constellation Software, with other software companies. Is that justified, do you think, right now, those concerns, or is it a bit of too sharp of a sell-off?
So I think the one thing that is underappreciated about Constellation with regards to AI is that they also have the opportunity to use AI within their own business, whether it be to save costs by writing code more efficiently, whether it be to use to sell AI-powered features. They've launched a few of those in some of their markets. Or whether it simply be because they are the ones who have the domain expertise in the markets that they are operating in. And so I think that historically, for example, a lot of the legacy software that they have will now have the opportunity to be upgraded with the use of AI. So I think a lot of the value will end up accruing to a provider like Constellation Software.
And potentially some of that big spending we've been seeing paying off for a company like this.
Exactly.
Yeah. Okay, so we're going to take another quick break right now. We will be back with Ernest Wong of Baskin Wealth Management taking your questions on North American large caps right after this. Stay with us. Welcome back to Market Call. We've got Ernest Wong on the show today taking your questions, and we will start with a caller. Chris is calling in from Delta, BC with a question. Hi there, Chris. What's your question?
Oh, good morning. Thank you for taking the call. Ernest, I'd like to ask you on Pembina Pipeline and maybe just the pipelines in general and which one you think offers the best value for a long-term dividend income-focused investor moving forward. Thank you so much. I'll hang up and listen.
Okay, thanks very much. Do you have a preference in terms of what you think is best?
Yeah, so I think what we're seeing with the pipeline sector in general is consolidation as the energy sector overall in Alberta is consolidating into larger producers. And so what pipeline companies like Pembina and Keyera are doing are kind of offering a full suite of services to companies that are extracting oil and gas to both process their gas and find markets to move it to. I think we think both of them are well positioned to benefit from all of the projects that are being worked on today to move Canadian energy to other markets. They're very well-run businesses. They have a strong pipeline of growth projects ahead of them that they're going to earn good returns on. And we own both of them for our income strategies as well.
So those two would be your preferences then?
Yes.
Okay. We've got Steve calling in from Brampton, Ontario with a question. Hi, Steve. What's your question?
Oh, hi. Good morning. Thank you for taking my call. The question is about the Nvidia, especially in the view that I know there's an earnings report coming up tomorrow at the end of the bell, 4 p.m. And the results will be out on Thursday morning. Is it a buy, especially keeping in mind and view the earnings report tomorrow? Would you recommend as a buy as of today, or you think the stock could go down substantially, especially after the earnings report? Thank you. I will listen to that.
Okay, thanks for your question. Yeah, all eyes on that earnings report tomorrow night. What are your thoughts?
So I'm personally not too concerned about the earnings report for Nvidia. I think what we want to look is maybe 2 or 3 years out to see what earnings are going to be then, because for something like Nvidia, we already know that chip demand is going to be through the roof because all the data centers cannot get enough of them. I think what worries me about a company like Nvidia is when you see someone like Meta going out and signing a deal with AMD. They are clearly motivated to find alternative sources of chips. So the key for Nvidia is that they need to remain ahead of the competition. And so for us, what we prefer to own is maybe some of the infrastructure providers. For example, we own the hyperscalers, we own Taiwan Semiconductor, which are kind of equally exposed to the AI trade, but I think have more confidence in the long-term durability of the business.
How does Nvidia stay above the competition, as you mentioned, like AMD? Do they have cheaper chips, or what's the main challenge there for a company like Nvidia?
Yeah, so the challenge is really ensuring that their chips have the highest performance, whether it be on energy consumption and things like that. But the reality is that with semiconductors, if you go through the history of semiconductors, it's a very, very competitive market, where if you just stop to rest for a moment, somebody else is going to overtake you. And so that is probably one reason why it trades at a relatively moderate multiple relative to the growth.
Got it. Okay, back to the phone lines. Peter is calling in from Vancouver with a question. Hi, Peter.
Hi, good morning. 恭喜發財，身體健康. That means Chinese good fortune and good health for Chinese New Year.
Thank you.
On the BNN is a great channel, and with many changes of horse over a decade, and but the CEO stayed the same. And even Taylor's changed the CEO, and your CEO is not doing a great job.
Okay, thank you for that. So I guess this question is BCE.
Yes.
Obviously, disclaimer here, Bell Media is the parent company of BNN Bloomberg, as Peter kind of mentioned there. So thoughts on how BCE is doing, especially, compared to some of the other big competitors, I guess.
So the big picture for the Canadian telcos is that there was an overhang on whether they were going to cut the dividend or not. And so BCE was kind of the first one to take that step. They cut the dividend last year. TELUS, we'll see what they do. Yeah. But then I think the big picture for the Canadian telcos is that there is, number one, the regulatory challenges are not going away. Historically, they've kind of the main tool that they've used against regulators was that they would invest in rural areas. But today, rural areas have Starlink.
Yes.
And they have alternatives, which is leading kind of to more competition within the urban markets that they compete in. The second thing is that the wireless competitive market has meaningfully changed because of Freedom Mobile and Quebecor. And so I think that there's no reason to think that we think these are permanent kind of challenges to the business model of the telcos, and don't expect that they're going to bounce back anytime soon.
Okay. We've got David calling in from Toronto now with a question. Hi, David.
Hi, good to be with you both. My question is on TMX Group. Phenomenal company, I think. Last couple of weeks, their stock just dropped a little over 20%, and they've, of course, increased their dividend by 10%. So just wondering what your thoughts are. Thanks very much.
Okay, thanks for that. So we'll start with that drop you can see there on the chart for TMX Group. What happened there?
So I think the drop, again, was related to a general fear that AI was going to disrupt all data-related companies. Mm-hmm. And what we're seeing is that the market is really kind of indiscriminate about the business models that these companies have. Anything that is data-related is just being sold off. I think for TMX Group, the kind of the challenge, the segment that is at hand is their analytics business, which is largely comprised of Trayport, which is a kind of like a Bloomberg for gas trading in Europe. We think that this is a very, very difficult business basically impossible to displace by AI because they have unique connections to all the various players in the market. It was like a perfect storm of events for Trayport to even have been created as a company. And we think they're going to be perfectly fine in the long term. With their listings business, I think that's going very well because the TSX is home to about 50% of the world's mining businesses. And with gold prices and gold and silver prices where they are, I think companies are looking to take advantage of that, and they are going to the TSX.
I know David mentioned as well that they increased their dividend.
Yeah.
Yield is now just above 2%. Is that something that's important to you, or does that show confidence, I guess, in a company?
Yeah, I think you always like to see when a company raises its dividend, assuming that they have enough money to kind of meet their remaining obligations.
Of course.
But I think the key thing that we're looking for TMX is not really about the dividend, but more about the growth from the core business.
Okay. I believe we're going to take another quick break right now. So we'll be back right after this. Stay with us. Welcome back to Market Call. Ernest Wong, of course, still here answering your questions. We'll go to an email from Sunny in Brampton, Ontario. And this email reads, what does our guest think about the enterprise SaaS companies such as SaaS and ServiceNow and Salesforce, is the sell-off overdone due to general misunderstandings about AI competition rather than AI integration / collaboration? Thoughts on that email?
Yeah, I think that I would agree with that characterization, where the market is kind of indiscriminately selling off software companies without really considering their business model or the opportunities that they have with AI. And that's certainly the case with those three names in that email, which are Atlassian, ServiceNow, and Salesforce, where the worry is that somebody could come in and vibe code an alternative to these solutions out there. I think the reality is that the reason that customers choose software in general is not usually because of the price, but because of all the other stuff that comes with it, like the switching costs, the implementation into their business. And it's a very, very sticky product that companies just don't want to spend too much time thinking about. Now, I think what we've seen in past kind of inflection points of software, such as the transition to SaaS to begin with, was that there were new companies that came up to take advantage of this paradigm shift. Legacy companies that were not able to transition got disrupted and went away. But I think for most of those enterprise software companies, they've made AI a big focus. And they're using it not just to upgrade their products, but to improve their cost structures as well. And I think that's the element that investors are not really considering.
Okay, we've got a caller now, Matt, calling in from Saskatoon with a question. Hi, Matt.
Hi, thanks for taking my call. Ernest, I'm wondering if you could comment on Amazon.com. Specifically, I'm wondering if you could comment on their AI spend. I got a pretty good feeling for what Microsoft's going to spend their AI for, or do with AI, with ChatGPT, and Google with their Gemini, but I'm not really sure I understand fully what Amazon's doing with their AI spend. Thanks so much.
It's a great question. Thanks, Matt. So yeah, do you have any clarity on where that money's going?
Yep. So historically, over the last couple of years, Amazon has kind of avoided committing server capacity to the trainings of some of these mega model providers. I think that's changed now. They've recently signed some agreements with some of the model providers to provide training services. And I think beyond that, a lot of the compute capacity that they are spending on is just to really support their existing businesses. And this is true for most of the hyperscalers, where a lot of the AI capacity that they're putting on is not just fully committed for the next couple of years, but they have opportunities to use that for their other businesses. So in Amazon's case, they're able to use that within their retail business, for example, by kind of improving their advertising on Amazon.com, having like a shopping assistant and those kinds of things. And so I think that they are going to earn good returns on the money that they're spending, and we are confident owning the stock.
Okay, an email question now. This one coming in from Tejas in Calgary, and it reads, "Good morning. Can I get your outlook on George Weston and Loblaw?" Thanks. So yeah, Loblaw had some big news yesterday with funding expansions, renovations, thoughts on the company, and I guess Weston as well.
So we think Loblaw's is a very well-run company. They've been ahead of the curve on kind of most of the innovations that have taken place in the grocery sector, whether it be launching discount banners, whether it be kind of wrapping a loyalty program around a drugstore with the supermarket, whether it be kind of entering into ethnic supermarkets like the acquisition of T&T all those years ago. And the challenge for Loblaw's, though, is that Costco and Walmart in Canada are taking essentially all of the incremental growth that is going to the grocery sector. So what Loblaw's is doing is that they are trying to target the segments of the grocery market that Costco and Walmart don't participate in, which is similar to the announcement that they made yesterday, where they were going to build stores in rural communities where there is no Costco, right? And so I think that the stock has benefited a lot from food inflation over the last couple of years, and the valuation is not as attractive as it was, quite frankly. And so we wouldn't be a buyer here.
Interesting. All right, we've got another caller. Raj is calling in from Mississauga with a question. Hi there, what's your question?
Hi, good morning. Thank you for taking the call. My question is about Google. Especially since the earnings report came about 2 weeks ago on Google, and then the stock tumbled like 10-15%. And thinking and considering, is it a buy as of today? Is there a chance that the stock will make back up, or keeping in mind all the AI spending and all that? Thank you for your comments. Thank you.
Okay, thanks for that. Yeah, I'm assuming a lot of that, the stock tumbling, was due to the overspending we've been talking about. Thoughts?
So for the one metric for Google and the other hyperscalers that we are very carefully watching is the margins that they are earning on their AI spend. Because over the last year, depreciation costs have gone up as they've really ramped up the investment in AI. And what we're seeing is that margins are stable for not just Alphabet, but for Microsoft as well, where despite spending all of this money on AI, it is contributing to revenue growth. They're making money on it. And more than that is that it's allowing them to save costs on other sides of their businesses, where headcount is generally flat. The costs, their employee costs are, as a percentage of revenue, is falling. And so given that, I think you have pretty good confidence that they are, in fact, earning good returns on the money that they're spending on AI.
So you would buy or just hold at this moment?
So we own all the hyperscalers.
Okay.
We think that they will ultimately be the big beneficiary of all of this AI spend. And we think that even though there is some capital intensity, they are earning good returns on this money that they're spending, and it is all committed through the next few years.
Okay. Robert now calling in from Hamilton, Ontario with a question. Hi, Robert.
Hi, how are you today? First-time caller. I'm calling about Thomson Reuters. I've noticed since January it's dropped about 30%, and now it's gone up to 12% in a day. I was just wondering if there was a reason for it, and if this is going to be a continuing trend upward.
Thank you. Thanks for calling in. Yeah, Thomson Reuters, we were talking about this a little earlier. It's been an interesting year for this company.
Yes. So I think part of the worry for Thomson Reuters is that Anthropic had announced a legal AI-related tool that could kind of instantly write legal briefs. And so there were worries that this could kind of ultimately displace the need for Reuters solutions. I think the other factor that's contributing to the stock price drop was that simply that it traded at a very high valuation before this drop. So some of that could be related to that as well. Hopefully, we're now at an inflection point today where instead of looking to disrupt software companies, the AI companies are looking to partner with data providers that have kind of verifiable, irreplaceable data sources like Thomson Reuters to power their AI solutions going forward. And so hopefully the sentiment changes on the entire sector where they become valued as AI beneficiaries rather than disrupted companies getting disrupted.
Okay. We're going to take another quick break right now. But when we return, we will take a look at some of Ernest's top picks. That's next. Stay with us. Join us tomorrow on Market Call. Darren Sissons will be on the show. He is partner and portfolio manager at Campbell Lee & Ross Investment Management, and we'll be taking your questions on global and technology stocks. And if you missed Market Call, you can always check out our podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. Okay, time now for top picks with Ernest Wong. So we're going to go through these. The first one, incredibly interesting given the news that's coming out today. Your top pick is Netflix. Still your top pick today?
Yes, for sure. Netflix stock has clearly been impacted by the proposed acquisition of Warner Brothers. And I think there's two concerns. Number one is the amount of debt that they're taking on and whether they will enter into a bidding war with Paramount and match whatever Paramount is offering for Warner Brothers. I think the second thing that this acquisition has brought out is the worries that why are they even going after such a large deal in the first place? Is it because that they're getting disrupted? Is it because they're worried about competition from YouTube? And I think those are all the reasons why the stock has been really underperformed since the summer of 2025. We think that Netflix shares are a great buy, kind of regardless of whether they end up buying Warner Brothers here. If they don't get Warner Brothers, they'll get a large break fee from Paramount, and shares are trading at kind of near the lows of what they were in 2022. So this is for a business that continues to grow subscribers, continues to grow revenues and profits double digits.
And so that question that you just mentioned, where some investors are like, well, why are they doing this? Why are they going after such a big deal? What do you think the answer to that is?
So we think that this deal is fundamentally misunderstood by most, not just investors, but the broad public in general, where people view people think that Netflix is trying to acquire Warner Brothers to, integrate the content into Netflix and to ultimately, shut down theaters and do kind of the things that Netflix is known for doing. We think the primary motivation for Netflix to acquire Warner is financially motivated. We think the opportunity is that Warner Brothers and HBO are not very well penetrated internationally. And so Netflix sees the opportunity to leverage their reach in international markets to drive penetration of HBO. And we think that there's a tremendous runway for them to do that. They don't, and the cherry on top of that is that they can commit to all the things that people are worried about, whether it be keeping movies in theaters, whether it be maintaining HBO as a standalone service, or even syndicating shows to third parties. And so we think that it will be a very, very successful transaction for Netflix if they're able to complete it. And we think that shares are extremely attractive where they are today.
Okay, next up is Domino's Pizza. What do you like about Domino's Pizza?
Yep. So Domino's had a rough 25, kind of in sympathy with the other fast food sector, where the worries is that demand is not good because of the low-end consumer, and also the fact that all fast food chains had raised prices too much during COVID and the aftermath, and we're suffering from that going forward. We think that Domino's is different because, number one, they kind of deliberately kept pricing below other competitors. They have a pricing advantage over other pizza chains because they are fully integrated. They deliver their own food. And lastly, their financial performance has been really good. Yesterday, they announced they had a 3% comp in the US. Most of this was transaction driven. Contrasted that to Pizza Hut, which reported a couple weeks ago, they were -5. So clearly doing something right. And we think that they have a lot of opportunity to gain market share from both large chains and independents in the future.
Okay, and last up, Live Nation. This is your last top pick. What do you like about Live Nation?
So Live Nation is the largest concert promoter in the US and around the world. They own Ticketmaster. And I think it really benefits from the trend towards live music as streaming grows. And this is important because as streaming kind of proliferates, people want to have the live experience of attending a concert to see their favorite artists. And the artists also want to tour because it helps them build their brand.
Yeah.
There has been a kind of a positive regulatory development for Live Nation where basically the antitrust trial is still going to take place, but will very likely no longer result in a breakup of Live Nation and Ticketmaster. So that's been a positive catalyst for the stock, and we think it's well positioned going forward.
Okay, that is all the time we have. Ernest, appreciate you coming in studio. Thanks so much.
Thank you.
And just a quick note, Know Your Options is back, so you can tune in Wednesday at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. You can send us your questions at knowyouroptions@bnnbloomberg.ca. And that's all the time we have. Thanks for watching Market Call today. We will see you next time. Trading Day is next.